Happy Wednesday, everybody. It's 12:30. We'll get started in about 2 minutes. Before we get started, some housekeeping items. If you have questions, make sure to put them in the Q&A. And let me share my screen. I'm guessing everyone can see my screen and they can hear from me. If you cannot, then put in a chat, but don't need anybody to respond if you can hear me. Robert, firing questions. I like that. We'll discuss that when we talk about the Regulation A offering and go through some of the details. We will talk about the tax component to it. Okay, let's get started. Again, thank you all for spending your Wednesday, either morning or afternoon, depending on where you are located, with us today. Today, we're doing a webinar on how we put our investor capital to work in mortgage note investing. And I am Chris Sevigny, the CEO and founder of Sevigny Investments. Sevigny is a Virginia-based real estate investment firm focusing on buying and selling mortgage notes. We purchase both performing and non-performing loans, which we will absolutely be talking about in this presentation. We've got a team of 10 of us with experience in real estate, every asset class of real estate. And I have been around and done 5 prior funds previously. And for those who don't know what mortgage notes are, we will talk more about that process and how we do it. But high level, our goal is to buy loans at a discount, which gives us flexibility to work out new payment plans with the borrowers and then allow us to create a win-win situation. Interesting enough, this is a business that is not a net sum zero result, meaning somebody has to win, somebody has to lose. There's opportunity for all parties to come away victorious in note investing, which we will talk about in some of our case studies. Our mission is to democratize investment opportunities while providing that win-win solution to borrowers. And we do this by offering our Regulation A offering, which is open to both accredited and non-accredited investors. Now, many on this call have probably seen that our current Regulation A+ offering is closing. Now, I want to be clear, the company is not closing. Our other offerings are not closing. Every 3 years, the SEC requires your Regulation A to basically cease, and then you can launch future offerings. So what does this mean is as of October 21st, we will not be accepting any new investments into our Regulation A+ offering. It's the last time to invest or make additional investments in this share class. We will be eliminating the bonus share program, which starts at $25,000 that we will talk more about. And again, for current investors, you stay the course. If you invested a year ago, nothing changes. We'll target to continue issuing your monthly distributions until your redemption period. And at that point in time, you can continue to stay, you can redeem. Nothing has changed from that perspective. So we want to be very clear that the company is continuing to operate. It's just this one share class is what is going to be shutting down. So let's talk about the Regulation A+ offering. As I mentioned, it is open to both accredited and non-accredited investors. There is a 4-year lockup period within the offering, and minimum investment is $5,000 with bonus shares, again, starting at $25,000. We'll talk a little bit more about the bonus shares in some future slides. And investors, we target a preferred distribution of 8%, which can get enhanced through investments that also have bonus share participation. Some other highlights. It's open to both non-qualified and qualified accounts, meaning self-directed IRAs. Distributions, we target to pay those monthly. It's a non-correlating asset class. And I've, over the last week, spoken to approximately a dozen investors, and the world's a crazy place right now with government shutdown, everything that's going on. And the question we get asked a lot is, one person used the word chaos, and does this create chaos, create opportunity or harm for our investment? And our response has been, the current situation, we are seeing an abundance of loans come across our portfolio, which we'll talk about later. But as we see default rates rise on loans and taxes, insurance, and everything increasing, sometimes that impacts the stock market. That might also impact other types of offerings that rely heavily on debt. For us in our asset class, we've seen more opportunity. We also look to seek up to 3 times collateral coverage. I have a slide that talks more about that later on in regards to the loan to value and investment to value. We've got over 100 assets in our portfolio. We do not charge management fees. I am an employee of the fund. I collect a salary. I do not get to, I'll say, take any of the profits of the company until the investors' distributions, everything has been paid. So us, it's not, we're collecting all these fees up front. We put them on the back end, which we think is more in alignment with how we want to work with our investors. Taxes, we issue 1099s, not K1s. We do not have a question about tax benefits. There's not, like other funds, accelerated depreciation or other components, but we are a corporation, a C corporation, that issues shares to a company. And on that 1099 div, there's return of capital, qualified dividends, and non-qualified dividends. And it can fall into any of those buckets that, depending on how long you've held your investment, that we could determine where it falls into those accounts. But it's very similar as if you were investing in a public stock company in regards to the 1099 dividend form that you receive. No K1s. Just want to, again, hash that, and no K1s. And those forms, by the way, are typically issued by the end of January. So we talked a little bit about 7E, what we do, the offering. If you're new to us, you might be asking, what is mortgage note investing? It is considered an alternative investment strategy where, if you've ever bought a home, you sign a lot of paperwork if you're getting a loan on that. And 2 of the major documents you sign are the note, which is the IOU that says, I'm going to pay back the bank $100,000 at 6% interest over the next 30 years, and my payment is $600. Then there's another document called the mortgage, which is the securitized document that gets recorded that basically allows the bank to say, if you don't pay on this IOU, I can go take that property potentially from you. And most people think banks do that. There's now a lot of non-bank lenders, there's credit unions, and all of these get, put together, and they're always sold. If you get a letter in the mail that says, please make your payments to XYZ, usually it's about 90 to 120 days after you refinance or buy your property. It's because your mortgage has been sold. Now, us as investors dealing in the non-performing space, typically we can buy these at a discount. And when we buy these, again, the borrower's obligations now come to us, meaning payments are now supposed to come to our entity. And people ask, it's great, I've never heard of this type of investing. Is there enough assets out there for you at 7E to be able to find enough product? Well, the market itself is over $16 trillion. And there's 83 million homes, roughly, single-family homes that have mortgages on them in the U.S. So when you look at that, current default rates are 1.5%. Historical norms are 3 to 5, starting to tick up. But at 1.5%, that's $250 billion in non-performing loans. Again, $250 billion, or 1.5 million homes. We've got a portfolio of a little over 100 loans, and not all of those are non-performing. We have a balanced portfolio. So think about it. We always say we're a grain in the sand on the beach in regards to the entire industry. So how do we put investor capital to work? It's not only how do we, but how quickly. And as I mentioned earlier about kind of the comment about chaos, is currently let me step back. A year and a half, 2 years ago, when we were starting the fund, buying loans, we're reaching out to sellers and really having to put a significant effort into our outreach, building new relationships, even though we had a lot of existing relationships, to make sure we had continual flow in getting the monies out the door in a timely fashion, which we believe we did. Fast forward to today, we have a backlog of, sorry, I forgot to put my phone on mute, a backlog of, I'll call it soft closes of probably a good 2 months. And what that means is as loans pay off or we close them from our books and the money comes in, as well as, we continue to raise capital, we already have a home for that for essentially the next 2 months of capital coming in the door. And that continues to grow. So that is, again, for us, seeing significant opportunity. Now we see this opportunity, but let's explain how it actually works. So we will go out and buy or originate loans on single family homes. And sometimes there's some loans in a tranche, or the pool of assets is another term, or a group of assets that we buy. And sometimes there's some in there that we may not want to hold. For example, if you've listened to our other webinars, this was an asset in Montana. We do not invest in Montana. Our servicer doesn't service in Montana. We took that asset and essentially got under agreement and then already turned around and flipped it. So when we closed on it, a week later, we sold it to another investor and made some money on it. That's not our primary function, but it's an option. The two primary functions are through the borrower, which is the top row, or through the property, which is the bottom row. And what do I mean when I say through the property or through the borrower? So through the borrower is where we reach some sort of agreement with the borrower. So typically we negotiate payments with them. They start paying, we generate cash flow. And after that period of time, we can sell it as a performing loan. The borrower may sell the home. The borrower may pay off the loan. The borrower may refinance a loan. As you can see, there's many different options that can come into play. The other option is sometimes the borrower, we can't work something out. Borrower could be deceased. Borrower could have gotten divorced, doesn't want the home. Borrower just can't afford it because taxes and insurance now are so expensive. So how do we work through that process? That we do it through the property, which is, getting ownership of the home, which could be a deed in lieu of foreclosure, which is something actually I just signed some documents on a property today that the borrower did not want a foreclosure on their record and wanted to just sign the property over because they couldn't handle it or maintain it any longer. There is that foreclosure process as well. Once we get ownership of the home, then our exit is essentially at some point to sell that property. We previously have sold properties to investors, homeowners. In some instances, foreclosure sale, it gets bid up past what we are owed, so it's sold at auction, and we never even have to. Now, we mentioned non-performing loans and loans, so I've been throwing out there. Let's define them a little bit. Performing, borrowers making their payments, meeting those obligations. Those can be purchased sometimes at a slight discount to collect the payments, or in some instances, they're shorter term loans, potentially to like a real estate investor, and we collect the fees and payments. Non-performing, borrowers not meeting their obligations. The loan is in default. Now, typically these get purchased, of course, at a greater discount. In some of them, up to 60% off the loan balance. We've recently bought some as low as 80% off of loan balance on them. It's all fluctuates depending on state, property values, Different factors come in to us to target a specific return. And when we do those, we work one-on-one borrowers to what we use the term fix and flip the loan, try and work with them to get them on some type of plan, fix up their credit, and sell it back as a reperforming loan. Now, one thing we also like to share is typically in the past, our non-performing loans, average delinquency 2 to 3 years, even longer. We've had loans that have been 10 years without any payments. So it's not a situation where somebody is 30 days behind. It is they're significantly longer behind or significantly further behind. I mentioned previously also, we like to target that 3 times the equity coverage. And this really focuses on our overall strategy of this type of investment being an income play where investors are, at the bottom of the capital stack, meaning closest to the origin, and look at it from the standpoint of also trying to keep the investment to the property value in line with our overall strategy. And how we do this is a lot of times the loans we buy might be 5, 10, 12 years old. And what has happened in the last 5, 10 plus years in real estate? Prices have gone up. So if we take a loan that's 8 years old that has a $150,000 balance on it, when that loan was originated, it could have been $200,000, but today it's $250,000. Now that loan, property values typically tend to rise while loan balances typically tend to go down when they're paying. So it creates that more of a cushion. And then if they even go non-performing, we're buying that loan potentially at a discount. Here we show $90,000, which is $90,000 out of $250,000 is only a 36% investment to value. So for us to cover the investor's original investment, we would need to get $90,000 out of this deal on a $250,000 property. We would have to be off by a long shot on the valuation of that property to really drive that price down. Now, even if the property, we bought this loan for $120,000, would still be a 2-to-1 type of coverage in that situation. So property values are starting to soften in most places. I think everyone's seeing it. But when we have investment to values at 35, 40, 50%, for us, we feel comfortable being in that position. I mentioned a few minutes ago about how soft closing on assets that we've got in the pipeline. And a lot of people ask us, well, how do you acquire and manage these assets? So I do want to spend a few minutes on that. And of course, we always have other webinars where we dive deep into how we do what we do. But securing a mortgage note, very similar to buying a piece of real estate. Put a bid on the property, they accept, they counter, goes into a due diligence period, which is like an escrow period. Due diligence here, typically 2 weeks, compared to a property, usually about 4. If during due diligence we find potential issues, property value may be off. The issues with the loan documents, issues with title, whatever could come up, we may fade the bid. And then they agree, we close, now we are the lender. The thing I do find interesting about this entire process is you don't go under contract until you close. You might sign a non-binding letter of intent up front, but during this whole process, it's all, I'll use the term old school handshake deal agreements. So that it's a tongue twister. The due diligence period, we like to call them the 3 Ps: the property, the person, and the predicament. People ask, do you cherry pick? I mean, you get to select every single loan. How do you know you're not buying one that's a doozy or a bad loan? We can't. Due diligence will never uncover everything. But when we follow our checklists, our lists, our SOPs, and on the property, we make sure it's clear title. We check the property condition, have somebody go to the property and take photos of the property for us. because we can't get inside these properties. If someone wanted to come knock on your door and say, hey, I'm here from the mortgage company, hopefully you wouldn't let them in. But that also kind of gives us the condition along with the value of the property. And most importantly, also the lien position. If we think we're buying a first lien position, we want to make sure that it is a first lien and not another lien in front of it. Make sure taxes aren't owed on the property. We've seen properties that had $50,000+ in taxes owed. That has a big impact on your price because taxes come in front of your mortgage. Then we look at the person. We run background/skip trace on them, criminal history. We've had, I think the longest rap sheet we've seen was 17 pages, was I think the record that we've seen. Financial history, bankruptcies. I think 7 or 8 bankruptcies is the most that we've seen. Mortgage payment history, we get to see, how often they make their payments. Are they the type of person that pays once every 3 months that just doesn't get far enough behind or gets caught up so you can't foreclose on them? Those being in that purgatory are the worst types of loans in my mind to actually own. And just really looking at the history of this person, which kind of rolls into the predicament of why are they not paying? Is it due to death in the family? Was there divorce? Was there a health issue? Was it job loss or situational? Or is it, this might just not be, might have different morals or standards than you have. We get to look at these and really paint that picture of all of the person, the property, and the predicament to say, okay, is this something that we are comfortable with buying this loan where we feel we can come to a resolution that is in the best interest of all parties involved? One of the big questions people ask us is, I hear that you're in 20+ states. How challenging is that? How risky is that? For us, we have an attorney in every state because every state laws are very different. So it's not that foreclosure laws follow any type of federal standard. There are federal standards to a CFPB, but how to go through that process is a state-by-state basis, along with nuances between if documents are lost. Is that okay? Is that not okay? If documents have incorrect language on them, is that okay? Not okay? Bankruptcy, even though I always thought bankruptcy was federal, it's very different in not only each state, but each jurisdiction of each state on how they handle it. Now, a lot of the laws are similar, but it still gets handled very differently. And of course, statute of limitations. I mentioned earlier, a loan was 10+ years without a payment. In Georgia, that would not be, it's past the statute of limitations. This was in another state, it was okay. So being able to use all this, and actually, question just came through that is actually a great question of how do we use AI to improve operations and optimize returns? So we use AI, absolutely. Of course, we use it for assistance on some of the social media and some of the stuff we do, but and we use it to evaluate certain aspects of it. And I'm a big proponent of AI. I'm sorry if I said social media. I meant AI. But I want to be careful with it as well, because I can share an example we're going through right now with a borrower, and we are trying to negotiate with them on the outstanding debt. And the borrower is using ChatGPT instead of an attorney. And the ChatGPT responses that they're getting, I'm assuming I just use ChatGPT as AI, so I apologize. It could be any of the other ones, but I'm just saying ChatGPT like Kleenex instead of tissues. And their responses make 0 sense and reference certain legal cases that have nothing to do with what we are or what we do. And I mention this because AI can absolutely be used for certain characteristics, certain things. For example, we have all this information you're looking at, statute of limitations. We have that in our Microsoft world. And we have created a Copilot agent within Microsoft Teams that can go in and say, okay, what attorney do we use in this state? Or what is the statute of limitations? And it will go pull that reference and can find it for us. That does improve efficiency, operations. So it improves time, gives us more time to focus on task at hand. But of course, we're always going to run certain things by an attorney because, what we have found is AI cannot replace an attorney. If you've ever seen anything on the news and stuff, there's people who've been disbarred for referencing wrong legal cases because they were using AI. Good question, though. So we bought the loans, we've gone through the due diligence, and we're like, moving forward, let's go. What does let's go mean? Typically, we start out with sending a demand letter to the borrower to bring the borrower back to the table. Why? Because how many of you get a piece of mail that if you don't know who it's from, you just take it, throw it in the trash? I know I do. And I think a lot of other people do as well. But if I go through my mail and it says from the law offices of XYZ, that will perk my interest and basically, oh, I probably should open this one. That's why we send a demand. Let's get the borrower back communicating through our servicer, who is that intermediary, like property manager in real estate, who deals with that borrower. We try and work out some type of trial payment plan with the borrower, which is a payment plan. It's a trial, introductory period. If you do this for 6 months, we'll then permanently modify the loan, or 3 months or 9 months, whatever time period you have. You don't want to modify the loan up front, because if you do and they don't make any of those payments, well, now you got to wait another 4 or 5 months before you could start legal action again. Trial payment plan also, it kind of just puts everything on a pause. So it's like, we're pausing. Let's see if this works. If it does, then we'll move to the next step. Assuming the borrower lives up to their obligations as well as us, then 6 to 12 months of payments come in the door. The loan gets recategorized or classified as a reperforming loan. We'll look to sell it back on the open market. And typically, we'll sell it at a discount from the balance of the loan, but at a greater number than what we bought it for to enhance our return. We also manage loans in bankruptcy. I'm not going to dive too deep into bankruptcy because I could talk for days about bankruptcy between chapter 7 and 13. What I want people to understand is if you are a first position lien holder, which we, majority of our loans are, you do not, people think bankruptcy, oh, are you getting wiped out? No, we don't get wiped out in a bankruptcy. They may either restructure the payments that are owed to us under a chapter 13 or in chapter 7. They typically will look to liquidate that property. As I mentioned earlier, when we talked through the borrower and through the property, just gone through a lot more detail on things. I just want to, again, rehash of how we put the money to work and how we exit to put it back to work. So as we mentioned, as we go back to that exit again through that borrower, we get them reperforming again. We can again sell it on the market. We can accept a short payoff. They can refinance. They can sell the property. Just this past Tuesday, which was yesterday, my days of the week are all a little fuzzy this week for some reason. We were working with a borrower who got a property under agreement. Our loan balance was $425,000, rough numbers. They had it under agreement for, I think, $460,000. But by the time they paid the agent's title, there were some taxes owed on the property. The balance that was left for us was $418,000. Technically, we could have halted the sale, said no, told the borrower, nope, you got to come up with the $7,000 delta. We bought the loan earlier this year for less than $400,000. We're between $350,000, $375,000, rough numbers. Okay. Now, for us, we can get, I'm a proponent, bird in hands better than two in the bush. Now, we can get that $418,000 and make quick $60,000, $70,000, or try and fight and maybe not have this thing sell. But then if we take it back, we're going to have to pay the taxes. We're going to have to maintain it. We're going to have to pay the HOA. We're going to pay the utilities on this property. In itself, that would have cost us more than what we accepted on the short payoff. So in some instances, it's, again, a win-win for all parties because time is money in note investing. Now, as we mentioned, through the property, deed in lieu, borrower does not want a foreclosure on their record. They'll hand you the keys back and sign a document saying so. Sometimes they sell the property. We have been seeing that a little bit more lately, or the potential foreclosure. My favorite topic here, I'm going to dive into case studies. Here's a traditional mortgage. This is what I will say is our bread and butter loan. This was in Denver. We bought it at a 30% discount, significant equity, borrower's not performing. This one, wow, over 2 years ago now. Time does fly. Borrower's 9 months behind when we bought this loan. To bring them current, they agreed to that trial payment plan, which was a down payment about 2x their regular payment. And also, they agreed to increase their normal payment by another 6%. They increased the interest rate, just the amount of payment they increased to try and catch up a little more. After 6 months at this new amount, we modified the loan. And what we also did is all that past due, we added it to the balance. So now it's an interest accruing to that balance, which actually enhances the value of the property. The value of the loan, because when you go to sell it as a Reperformer, has a higher balance, you get a percentage of that. So it increases that value. And work that out, and then borrower signed modification, and shortly thereafter, we sold it. Interestingly enough, about this case study was people ask, why do banks sell loans? And in this instance, it was a credit union, and the borrower had been trying to work with the credit union. And when you try and work out a new payment plan with the bank, they're going to have you fill out all this paperwork as if it's a new loan origination. Like you're getting a new loan. If you've ever gotten a loan, you got the 1003, you want this, bank statements, tax returns, and then they keep asking for more and more and more and more. What happened was the bank has a 90-day rule of information can't be more than 90 days old. So by the time the borrower submitted it and it made its way through everybody in the bank and got to the last person, it was 110 days old. Stamped or rejected, say start over again. After the second time doing that, definition of insanity, doing the same thing over and over again, expecting different results, bank's like, we're just going to sell this. Let's not fix our process. We're just going to sell the loan. Here's another loan. This was a short-term loan that we acquired. This was a investor owned this property. That we acquired this at a 65% loan to value, but it was non-performing. And we bought this loan earlier this year, and it was a non-owner occupied construction loan for an investor, but the loan had matured. And property was completed, and property was on the market for sale. The issue was the lender did not want to continue to extend them out any longer. So they're just like, oh, you're in default, maturity default. We have too many defaults on our books. We're going to sell off this loan. And once we acquired this loan, we reach out to borrower, confirm, hey, look, still selling it. It's on the market. What's your plan? How do you want to get this paid off? They're like, yeah, we're done. It's just the market's soft right now, and we need some time to sell this off. So we're like, okay. When we checked, there are no construction liens or anything like that on the property. So we had the borrower sign a 6 months extension, which pushed the maturity date. And as part of that extension, we collect a fee. And then they started making their payments again, because when it goes into maturity default, the lender typically doesn't accept payments. You have to pay everything. And we waited until the borrower sold the property, which they did, and we got paid off. And this happens a lot more than you would think, honestly, in seeing some of these properties where they're on the market for sale and non-performing and they're in great condition. I want to reiterate too, when people think of non-performing loans, they think of distress, which makes it think that the property is in deplorable condition. This is a brand new construction house. A lot of the loans we see in that middle income, kind of the $300,000 to $750,000, houses are in very good condition. Here's another loan that we took to foreclosure, and this property acquired at a 40% discount. Again, 60% investment to value. It was non-performing. It was a pool of 23 loans we bought earlier this year. 12 of the 23 were to one investor in Tennessee that took out loans to, rehab the properties or turn them into rentals. And what they did is, in many instances, they did rehab the properties, but then when they started collecting the payments, they just pocketed the tenant payments and never paid their mortgage. The borrower on this received over $1 million loan, and I think they were 22 years old, and were given high percent financing, which blew our mind, which is why the discount was significant. So on these assets, we initiated foreclosure right away. Tennessee is a non-judicial state, meaning it's fast. We were in and out in, this one was in June. And in this instance, the property sold to a third party. So it went to auction and somebody else bid above us and we got paid off. We've had several other loans with this investor that we bought, that we foreclosed on, that had tenants in, and the tenants were paying. Property's in great condition. They've been paying, and we just kept these tenants in place until we look to sell the properties next year. So it's usually when you foreclose, you have to fix it up or, sell it, and it's a burden to you because you're paying the insurance, the taxes, everything else, and no revenue's coming in. In some of these instances, a lot of them had actually revenue coming in the door. So we talked about note investing. We talked about 7E, talked about our Reg A. Just want to remind people, again, last opportunity to invest in our Regulation A+ offering. Why 7E? And why should I consider looking at your Regulation A offering? One is monthly distributions. We target the distributions for shareholders. We have a Reg D for bondholders. We issue them monthly. So it's not quarterly, semi-annually. We communicate constantly with the borrowers. If there's ever a problem, you will know about it in an expedient time frame or manner. Bonus shares, there's that potential for the additional bonus share program, which is going away in any future offerings. It will not be offered in any future offerings. We are offering it to people who get in with us on that ground floor and who've been in with us the last few years or are looking to get in with us right now. We mentioned we're not correlated to the stock market. We're, considered a diversification outside of that stock market. We talk about risk-adjusted returns. We vet each loan. We target properties that have the equity that we feel meets our requirements. We try to focus on the single to doubles and keep that diversified portfolio. Like I said, we got over 100 assets in our portfolio. It's not relying on 2 or 3. If one goes bad, then, oh boy, we're in trouble. We've got a very diverse portfolio. It's hands off. We manage every aspect of the investment. So in that fashion, I believe it is truly passive experience for the investors after they invest. A lot of people come to us who invest in real estate and have been selling off their rentals because they don't want to feel like to deal with tenants, toilets, termites. They want to buy back their time. And I think that's an important consideration for everybody is, can you buy back some of that time? Because time is one of those only things that, we can't create more of. And then, let's say a white glove investor experience. Our team is in-house, our asset management, our investor relations team. Everything you receive is from members of our team. If you pick up the phone and try and, and look to call us or email us. You're speaking with a member of our team who is picking that up. If we don't have an answer for you, we will let you know, hey, let me look into it. Let me get back to you. We do not let things linger for a week and realize I never got a response. What is going on? We don't know the answer. We'll let you know. We don't know right now. Let us get back to you. Question has come through. Is this recorded? Absolutely. This is recorded. After this webinar, everybody will be receiving, the link for the recording. So if you missed anything, don't worry, you will get the recording. Let's talk a little bit about our experience. And when somebody's looking to invest with others, I believe, this is just my opinion because I'm also an investor, experience is a significant factor that I look at and come into play. I want people who have some experience in what it is they're doing. For us, we've done over 750 deals, values over 100 million. We've been in 40 plus states. Now, I'm not going back into some states we've already been into. The grays on the side here are probably from some of those states that we've been in. New York, for example. Had a few loans in New York, but we just don't invest in New York. It's too challenging. You can't control the time. And it can take years and years in New York to potentially foreclose on a property. We have done 5 prior full cycle offerings. As I mentioned, we have that vertically integrated team of people that you pick up the phone, you're speaking with somebody that is a member of our team. And to date, historically, we have never missed a distribution to investors. I do have to caveat, past performance is not a guarantee of future success. Anybody that tells you differently, I would disagree with. Okay. Just saw this question pop up. Wow, perfect timing with that question. As we mentioned, bonus shares, as we wrap up our Reg A, are going to be going away. How does our investment process work for these Reg A shares? $5,000 investment is the minimum. It targets 8%, which is a $33 a month distribution. Now, I will say we go by calendar days in a month. So January will give you more than February. And usually for first-time investors, early March, we get a lot of people calling us. Why was my payment less than the prior month? January has 31 days, February 28, except for leap year, of course. So that's the average. 10,000 doubles, but then you get 25,000, and then you get bonus shares. You get 4% increase. So you are going to get essentially your distribution will be based off of a $26,000 investment. So you'll get additional monthly distributions or additional monies to that distribution based off of that increase of bonus shares. Then when you go to redeem, you can redeem those shares. That gives you that kicker at the end, which gives you that 9.9% IRR, which, just for people for IRR, that's the flow of cash flows. First 3 years, I think it's like 8.5, but that last year, because that bumps it up, that gives you that overall return. 50,000, get a 5% bump. So you get a $2,500 bonus. Now, if you invest 60,000, still 5%, so you get 3,000. So it's not locked at that number. It's that percentage that goes through. 100,000, 6% out of one hand now. 250,000, 7%. So shows you as you move up the chain, those bonus shares can add to those targeted returns. Another question, what did it mean by full cycle offerings? Those were funds that we started, closed, investors got all their money back. We do have a track record verification report based on that, which is a third-party report through an outside consultant that looked at the information we provided to them. And if we said, hey, this is what we returned to the investors, they went through our bank statements and everything else, and we're like, yes, we reviewed all this and that information is deemed correct. Think about Similar companies do it like for Morningstar. If a stock has a 5-year track record, it's not the company that puts that information or is the one that publishes it. They have to have that verified so they can publish it through a third-party verification company. Very similar thing we did for our funds. And honestly, it wasn't a lot of money to get it done, believe it or not. A few more questions that I'll hit upon as well. Could you talk about the returns? Is it fixed or flexible? So they are preferred equity returns, meaning they're fixed, but again, they're not guaranteed, meaning that if all of a sudden the company had to take major hits somewhere, if we ever had to cease distributions, which we never have, doesn't mean those payments are guaranteed in any way, shape, or form. So this is not like an FDIC, federally insured money market account or anything along those lines. Another question was the actual return track record based on the 5 prior funds. It was a little over 14%. And if people, I'll share our email in a second. You can email us. We're happy to provide that information. Is it possible to compound the returns? Great question in reinvested distribution. Unfortunately, the answer is no to that. When we look to get qualified with the SEC originally in regards to putting a DRIP program, direct reinvestment, the hurdles to overcome with that were extremely significant and also would have added significant costs to the fund from an auditing and accounting standpoint. So we made the decision that we would not, and many of our investors invest for that income side of things where they actually would prefer to have the income coming through on a monthly basis. How is this different than the Reg D option? If accredited, which is better? I don't want to say one is better than the other. Each one has their different opportunities between them. Not going to go through every nuance on this webinar. I'm happy to jump on a call and talk to you about it, because depending on what you're investing with, how much you're investing, one may have some preferential treatment over the other. For example, potentially from a tax perspective, one might be better. But if you're investing with a qualified account like self-directed IRA, it can vary significantly. So I think it would be best have a call with someone from our team, understand what you're trying to seek and that investment, and go from there. Does the return go higher if the results are better? In the Regulation A, no, but we do have the ability that we could always offer additional. But right now the answer is no. In our regulation, we do have a Reg D offering that, yes, there is a profit sharing component that higher returns. In that instance, the investors share as part of that upside in that offering. And that offering is still open. That is not closing on the 21st like this one is. Which is better investment for qualified account? Again, the we see more people go to the Reg D with qualified accounts, but that has a $100,000 minimum than the Regulation A offering, but it also has a longer hold period. So the hold period comes in play. There's so many factors that, again, each investment has to fit your needs. So that's where one is not necessarily better, because what might be good for me might not be great for you. Next steps, kind of book a call with us. We'll share our link in a moment. You book a call. You can also go online, create an account, complete the paperwork, and fund the investment. I am going to put in the chat right now the link to where to go if you want to go in and chat here. cwsdalmoredirect.com/register. It is Mercury retrograde right now, and it's been a little bit quirky for some reason over the last day or two. So if you do have any questions, book a call, call us. If you're an existing investor, I recommend you just email us at invest@70investments.com because we can just complete their transaction very quickly over phone with you and get you to sign that document. Within the portal, if you are investing with a self-directed IRA, choose the corporation and LLC, and the beneficiary would be you as the person who's investing. So I just wanted to kind of make that note because that was one of the quirky things of the little button for IRA disappeared on us. So it's now under the corporation LLC. But again, recommend people book a call with us. Happy to answer those questions. We've got our calendars open between now and the 21st to make sure we can answer those questions to you. And to book a call, you can scan this QR code. I am also going to, in the chat, put in my booking link as well. So people also can go on and just book directly with me on my calendar and set up that call. Few disclaimers as we end. Any offering is, as we mentioned, there are no guarantees of distributions. It's not a guaranteed investment. It's an alternative investment that does involve risk within any type of investment. With that being said, let's open it up to additional questions people have. Nobody has any more questions? Again, thank you all for spending time today. And anything does come up at any point in time, feel free to reach out to us. Thank you. Have a good day.